I thought I'd just like to take a minute to talk about the development of Vanguard and the development of indexing at Vanguard, partly based on Gus's remarks. And first, let me say that there is in that Wall Street Journal article, it was so nice, championed the long term. I love that. And there was a comment by Holman Jenkins that an industry graybeard told me that I would ruin the industry if I started a mutual company. This was not a graybeard. This was a man named John B. Lovelace, or John Lovelace. His father, John B. Lovelace, was the founder of the American Fund Group out in Los Angeles, and John was the head of it. And he was a year ahead of me at Princeton. So calling him a graybeard is not exactly accurate. But he was an important factor in the industry, not a big participant. But that has always been a very well thought of group, and he was a great guy. And he had to see me when I was out in their offices. I visited around a lot in those days. And when I was out in his office, he said, "I have to see you." And I said, "Well, I can't do it now. I've got a lot of meetings with your people. And then I can't do it tonight because I've got a dinner engagement. And I'll be leaving tomorrow morning on the 7 o'clock plane to Philadelphia. And so if you want to meet me at the airport, I'll meet you in the diner at 6 o'clock. So I went to the diner at 6 o'clock, and all those covered little stools kind of thing, like linoleum or something. And in there was John. And after a very brief introduction, he said, "I've heard that you're going to try and start a mutual company." And I said, "That's true. I don't know if it's going to work or not. We're still in the middle of no man's land with the board of directors in the summer of 1974, and no one knew how it was going to come out." And I said, "Yes, that's what I'm planning." And he said, "If you do that, you will destroy this industry." But this is not a graybeard. This is a guy about my age, and certainly with my Princeton heritage. And he was very, very foresighted. We did not destroy the industry, but if he just added, "You'll destroy this industry as we now know it," that is exactly what is happening now. And the reason for that goes to a phrase I haven't used yet today, but I usually use it about 10 times a day when I'm trying to explain to an outsider and what we're all about. And that is, we started with the structure, the mutual structure, and then developed from that structure. I have a speech called Strategy Follows Structure, a low-cost strategy, the obvious thing to do if you have that structure, of which the highlight would, of course, be an index fund. So that was strategy and structure together. And it's amazing that it has worked this way. And I thought I'd just talk a little bit about the development of our index business. First of all, because the point I'm trying to make is every single thing I'm about to tell you was intuitive. We had not a single formula. I didn't understand most formulas. I can probably read half of the articles in the Financial Analyst Journal and the Journal of Portfolio Management. Or did I write half of them? I don't know, but something like that. And it was all intuitive. And starting with Vanguard Index Trust, First Index Investment Trust, as it was called, in 1975 when it was formed, I did a crude comparison of the companies and the mutual funds in the industry. There were about 60, was all. They're all pretty much large cap, blue chip kind of funds, very, very similar. And I compared them for 35 years with the S&P 500. You saw that slide in my talk. And the index won by 1.6%, I think was the number. And 35 years later, or maybe it was 38 years later, that is to say a couple of years ago, I decided it would be interesting to see the correlation of that group of mutual funds in terms of their performance, how much was explained by the S&P 500. So I put Knight Nolan to work, and it turned out to be 97. In other words, if I produced that number, I would have been really confident. But this was just done intuitively without any of that. Then I decided that the S&P 500 would be the preferred index. I hadn't really heard of much else. I knew the Dow Jones was a terrible index, and the Wilshire wasn't even developed by then, total market index. So we started with the S&P 500, and I thought, it might be a good idea for purists. We thought about changing the structure of the fund to be the total stock market. That made more sense, really. But no one had ever heard of the total stock market index. So in 1985, we created the Extended Market Index Fund, the Completion Fund. That's now our small, mid-cap and small-cap fund, and it's been very, very successful. But the original idea was the intuitive idea that you want to go out and get the rest of the market. Statistical studies about that? None. I didn't even know what the composition was. At that point, we brought Gus Sauter in because we now had 2 index funds, and we went on from there. We started a bond fund, I think in 86. That was not Gus's part of it. And then in 89, I think, don't hold me to these dates, I didn't look them up, but around 89, we started an international fund. And I had the intuition that EFA, Europe, Australia, and Far East, Japan was terribly overpriced. It was half the world's market cap at that time. So I thought it'd be a good idea to separate and have a European portfolio and a Pacific portfolio. Strictly intuitive, no data. The fact the Japanese market soon collapsed kind of vindicated keeping them apart. And that's where that came from. The small cap fund, small cap index fund, in 1990, roughly, came when the manager for the small cap index that we had, small cap managed fund that we had, came into my office, and I was telling him what a terrible job he'd done, and which he had. And he said, and this is the first time I'd really thought about it, I said, I think we're going to convert this into a small cap index fund. And we did. I wasn't sure exactly how the small cap index worked, but it's worked okay. It's basically the best small cap index around, although I don't like its concept particularly, but that's another one. Then we started those Admiral funds, for the original Admiral funds, for long, short, and intermediate term treasuries, based on the way we ran our municipal bonds, have the shareholder choose between yield and volatility. Then we started, this is a curious one, the growth and value funds. I had said probably in 1990, the development of our growth and value funds is going to the formation of our growth and value funds will come as soon as we have a growth and value index. I didn't know what would be in the index. How would I know that? So Standard & Poor's announced they were splitting the 500 into growth and value. So we started the fund, totally on intuition, on the basis that those two, growth and value, would be the same in the future. I warned people about switching on them, and they were. Turns out from then to now, 93, I think that was, growth and value had the same 9% return. It happens that Morningstar says that these two funds, growth and value, are the oldest and largest factor funds in the industry. So I will take credit for building the factor fund industry, but I don't want any credit for it because I don't believe in that. I started them for a very different reason. And I want to understand that you can have formulas and formulas and formulas, but if they don't comport with common sense, you don't want to have anything to do with them. You can prove anything with data. I've done my share. And so that's a little bit about the development.